cut to the chase, is this about dumb decisions in doing SPACs, et cetera, et cetera? Is it about the bank, the Marcus, and all the rest of it? What's the backstory leading to 3,000 plus layoffs today?
That certainly will be a touch harsh, Tom. Yes, what Goldman Sachs is doing is going deeper than rivals. It is shedding jobs and what any of the other banks have planned as of now. But it is really hard to pin it down just on mistakes. Their consumer banking foray has not gone great, and they have outlined a retreat there. However, you also have to look at the fact that through the pandemic, they didn't do the usual cut of underperformers as usual.
Right, Lisa mentioned.
And they've had a big jump in headcount. Under David Solomon, you've seen headcount increase 34% since the end of 2018 to almost 50,000 employees now. So while they are planning 3,200 cuts, that works out to about 6.5%. But just in terms of sheer numbers, it is one of the biggest exercises Goldman has ever carried out in terms of job cuts.
I'm showing my vintage, but does the leader have the partnership's support?
Partnership might complain and grumble about a variety of things, but you're emerging from a very difficult 2022 where the Goldman Sachs stock, even though it was down about 10%, it was still a better performer than almost all the other banks. It just pipped Morgan Stanley towards the end of the year and definitely way bigger than the bigger consumer banks heading into 2023. So if you have a lot of complaints at this moment, it feels a little misdirected if it is all targeted at David Solomon.
A lot of people have seen the job cuts as a positive. Certainly, if they're an equity investor, they see this as perhaps trimming some of the expenses in a positive way. Will it be received that way after next Tuesday? Will the earnings bear out that this is really a good exercise to prepare for perhaps a leaner future?
The earnings will definitely show you why they needed to do something like this. They have set return on equity targets. They're not going to meet that for the year 2022. They're barely going to tread water on the 10% mark. Their target is somewhere in the 14 to 16% mark. And of course, they will say we do not judge that on a year-on-year basis, but shareholders and investors don't necessarily look at the long term, even though they would like to think that's what they do. They look in the now, and when the numbers don't match, they want to see management taking some action. And that is why you see them going ahead and saying, we are tackling the uncertain environment we're heading into. We're tackling the ballooning expenses with this measure.
We already know that deal making has been slow. We've seen investment banking slow in terms of profits. We talked about the SPACs no longer. The easy money, I hate that phrase, but here we are, not necessarily there. But how much is this also because of, for example, loans that have remained on the books that had to do with mergers and acquisitions that were made during a better time and now having to accept losses? How much is due to just turmoil in the market gone awry in specific portfolios?
There's certainly industry-wide trends that Goldman is not immune to. You have had a big decline in investment banking fees. Let's not forget asset management. You've had a big decline in asset prices. And a year ago, that was a massive boost for Goldman Sachs. That helped them increase their revenue that year by 8 to 9 billion just because of price gains in asset prices. That gain is not going to be there this year. So when you lose such a big chunk and you have this little consumer banking experiment, the new division that they're going to unveil, which will have losses, or at least pre-tax losses that will show as more than 2 billion. It might be a bit of an accounting kirk, but it is still more than 2 billion. It's still a problem.
Tom, did you like how he did that? He called Marcus that little consumer banking experiment.
He's so smooth.
I love Sri.
Just like lights out. What are the 3,200, the 3,800, whatever the count is people do? They're going to go out, they're going to have parchment, a resume that says they worked at Goldman. Is it like they get a job right away? I mean, is there pixie dust involved here? Or is this going to be an HR slog for these people?
Look, that's the hard part here. We're all talking about how investors will react, how shareholders will react.
Yeah.
But this is also, at the end of the day, a very human process. You have going to have 3,200 people who are going to go out into a very difficult 2023, into a very difficult job market. Even though they say there is a war for talent, it is hard to imagine other banks. They might not be cutting as many jobs as Goldman Sachs, but they are still not going to be out there hiring aggressively. I will point out one thing, though, and this is important. As bad as the number is, and as hard as it is to say there is a little bit of good news here, there is a little bit of good news here, because just a few weeks back, management ranks were talking about cuts that could be approaching nearly 4,000. This is about 20% less than that. So if that's where the number is finalized, that's a small bit of good news.
On the tech side, we hear big tech companies laying off a significant portion of workers. We used to hear that there was a war for tech talent in the banking industry. How much are you seeing the banking vortex bring in some of the tech staff that's being laid off?
We certainly saw a lot of that over the last few years, but let's look at the cuts that are taking place this week at Goldman Sachs. All the conversations we've had with our sources across the firm indicate that a number of those hits will be affecting people who are working on the tech side, on the engineering side, because that's where you've seen a lot of headcount growth.
Interesting.
You can't just build a digital bank for the future without ramping up aggressively there. You can't roll out a lot of these new products without staffing up on that front. And that's a place which is ripe for cuts, unfortunately.
One question before we let you go. Is everybody back in their seats at the office? Is it being in person really important?
Well, over the last 2 years, one theme has been very clear. If there is one bank that has been adamant about wanting everyone back in the office, Goldman Sachs has been at the forefront of it. Heading into
Have they lost people because of that? Come on, you talk to everybody.
One would hope not. We'll find out at the end of the week. But surely, I cannot expect that being a factor in cutting jobs. But to Lisa's
No, but are
question,
there tech guys at Goldman Sachs having a tantrum because they got to darken the door 5 days a week? Cut to the chase.
they might have been throwing tantrums, and we certainly heard a lot of complaints out of 200 West over the last couple of years. But right now, they don't have a vent for those complaints. Right now, they want to keep their heads down and hope that they still have a job going into next
I mean, you're only working here. You're working 4 days a week at home, right?
I count 5 days a week in the office, Tom.
Really?
Of course he does.
Bassick doesn't do that. You know.
Yes, she does. Everyone works very hard here. Look, I don't think that necessarily being in the office also indicates how hard people work, but there is a shift back to a culture of being more in person,
Don't get me
particularly for the
going.
banking
I need the surveillance
industry.
cork on this. I got to be careful.